People say they want to build wealth, yet the moment the market drops, panic takes over. Why does volatility scare so many investors, even though history suggests it's often a normal part of long-term investing? Is fear the real problem, or is something deeper happening inside our minds?
That's a great question, because volatility doesn't just test your portfolio, it tests your psychology. Most people think they're afraid of losing money, but what they're really afraid of is uncertainty. Our brains are wired to avoid pain, and seeing investments fall feels personal, even when nothing has actually been sold. One of the strongest forces at work is loss aversion. Psychologically, losing $100,000 hurts much more than gaining $100,000 feels good. That's why a temporary market decline can feel like a permanent disaster. Think about turbulence on an airplane. Passengers get nervous because they can't control what's happening. Yet the pilot has experienced turbulence hundreds of times and knows it's usually just part of the journey. The stock market works much the same way. New investors focus on the shaking, while experienced investors focus on the destination. Another trop is herd mentality. When headlines scream, markets crash, and everyone around you starts selling, your brain whispers, maybe they know something I don't. But history repeatedly shows that crowds often become the most emotional at precisely the wrong moment. The psychology of investing teaches us that successful investing isn't about predicting tomorrow, it's about managing yourself today. I've met people who sold excellent investments after a 20% decline, only to watch them recover months later. They didn't lose because the businesses failed. They lost because fear convinced them the future was already decided. Volatility isn't always a warning sign. Sometimes it's simply the market repricing expectations. Imagine walking into your favorite supermarket and seeing quality products discounted by 30%. Most people would celebrate. Yet when quality companies become cheaper, many investors run away. That's emotion overpowering logic. Behavioral finance reminds us that markets move on news, but investors move on emotions. The difference matters. Long-term investors understand something powerful. Risk and volatility are not the same. Volatility measures movement. Risk is the chance of permanently losing capital. Confusing the two leads to emotional investing and costly investing mistakes. The wealth mindset isn't built during bull markets when everything feels easy. It's built during uncertain moments when discipline is harder than prediction. The next time the market falls, ask yourself one simple question. Has the business fundamentally changed, or has my emotion changed? That single question can separate a confident investor from a fearful one. Because in the end, the greatest investment isn't just in stocks or funds. It's in developing an investor mindset that remains calm when everyone else is overwhelmed. That's how ordinary people build extraordinary wealth over time.
If this conversation changed the way you think about market volatility, subscribe for more episodes on the psychology of investing. Remember, mastering your emotions may be the most profitable investment you'll ever make. We'll see you in the next episode.